bonds are an integral part of the financial landscape, and understanding how they work is essential for any investor. They offer investors a number of advantages, such as providing returns with relatively low risk. Bonds also provide security to lenders by offering them an assurance that their investments will be repaid. Furthermore, bonds can help fund governments and large businesses in times of economic hardship or when they are looking to expand operations. In this video, we will review the different types of bonds available to investors. Note: invest at your own risk. This video does not guarantee future success, implied or otherwise. U.S. Treasury bonds. U.S. Treasury bonds are an essential tool for investors looking to expand their portfolio and mitigate risk. These securities, also referred to as treasuries, are issued by the U.S. government and carry a low-risk investment. Since they are backed by the U.S. government, these bonds can provide an ideal option for those who want a steady stream of income over time, without taking on too much volatility in their portfolio. Treasury bonds come in two main forms: fixed-rate and inflation-indexed bonds. Fixed-rate bonds offer interest payments at the same rate throughout the life of the bond, while inflation-indexed bonds adjust to changes in inflation rates over time. Both types can be used as part of a diversified portfolio strategy, providing both income and protection from market volatility. Municipal bonds. Municipal bonds are a type of bond issued by local governments and their agencies to finance the construction of roads, buildings, schools, and other public works projects. They provide an important financial tool for cities and towns to fund major capital projects without raising taxes or increasing debt levels. Municipal bonds are typically considered to be a safe investment since they are backed by the full faith and credit of the issuing municipality or governmental unit. As such, they offer investors a steady stream of income that is usually tax-free at both the federal and state level. Additionally, municipal bonds often have lower interest rates than corporate or treasury bonds, which makes them attractive investments for those looking to supplement their retirement incomes. Corporate bonds. Corporate bonds are a popular way for companies to raise money from investors. They are debt securities that allow the issuer to borrow funds from investors at a set rate of interest for a specified period of time. Corporate bonds typically have higher yields than other investments, such as treasury bonds, and offer high-level diversification benefits. Investors can purchase corporate bonds in either the primary or secondary market, depending on their individual goals and risk tolerance. In the primary market, new issues are sold directly by corporations to institutions or large investors. The secondary market allows retail investors to buy previously issued corporate bonds from other holders at prices determined by supply and demand. Bonds may also be bought through an online broker or financial advisor. High-yield bonds. High-yield bonds are an attractive option for investors looking to increase their portfolio's rate of return. These types of bonds, commonly known as junk bonds, offer higher yields than the more traditional investment-grade corporate bonds. However, high-yield bonds come with a certain amount of risk that must be taken into consideration before investing. High-yield bonds are issued by companies with lower credit ratings, meaning they're more likely to default than other investments and therefore offer a higher yield as compensation for the increased risk. While these types of bonds may provide significant returns, it is important to carefully research the individual bond issue and consider your own financial situation before investing in any type of bond. High-yield bond holdings should also be limited to no more than 10% of total portfolio holdings so that diversification and overall risk management can be maintained. Zero-coupon bonds. Zero-coupon bonds are an increasingly popular investment option for those looking to add variety and generate long-term returns. These bonds, also known as zero-interest bonds or deep discount bonds, do not pay regular interest payments like other fixed-income investments. Instead, investors buy the bond at a deep discount from its face value and receive one lump sum payment at maturity. With their simple structure and low-risk profile, zero-coupon bonds can be a great addition to any portfolio. In general, zero-coupon bonds offer higher yields than most other types of traditional fixed-income securities such as treasury bills or corporate bonds. They also provide more flexibility in terms of when to invest in them because they don't require an investor to wait until the next interest payment period before they can purchase one. Floating rate bonds. Floating rate bonds are an investment option that can provide investors with a hedge against rising interest rates. These bonds, also known as variable rate or adjustable rate bonds, feature changing interest payments over the life of the bond. The payment amounts are typically based on a benchmark rate such as LIBOR or prime rate. This can give investors a greater return if interest rates rise during the course of their investment, but it carries more risk if interest rates fall. When purchasing floating rate bonds, investors should pay attention to several factors including creditworthiness and liquidity. Creditworthiness is important because it reflects the ability of the issuer to make timely interest payments and repay principal at maturity. Liquidity refers to how quickly an investor can buy or sell their investment without experiencing significant price losses. Convertible bonds. Convertible bonds are a type of bond that can be converted into equity at the discretion of the bondholder. These hybrid investments offer investors a combination of safety and potential return, as they are able to receive fixed interest payments while also having the option to convert their bonds into stocks. Many corporate issuers will choose convertible bonds as a way to finance their operations without giving up equity in the company, making it an attractive option for both companies and investors alike. The conversion process is fairly straightforward. Upon maturity, holders have the choice to cash out or turn their bonds into shares of common stock in the company, often at rates lower than what's currently being offered on the open market. This makes them a great investment for those looking to hedge against market fluctuations or capitalize on long-term growth opportunities within a particular company. Inflation-protected bonds. Inflation-protected bonds are a type of bond that can be used to protect against the effects of inflation. These bonds, also known as TIPS, or Treasury Inflation-Protected Securities, are backed by the United States government and offer a fixed rate of return above the rate of inflation. This makes them an attractive option for investors who want to ensure their investments keep up with the rising cost of living. TIPS have several advantages over conventional bonds. They provide a guaranteed rate of return that remains steady even when inflation rises, so investors don't have to worry about losing money due to unexpected economic changes. Furthermore, they come with built-in protection against default since they are backed by a government guarantee. Moreover, TIPS offer low volatility compared to other types of bonds such as corporate bonds or municipal bonds. Foreign bonds. Foreign bonds are a type of investment that offer investors an opportunity to diversify their investments and take advantage of global markets. Foreign bonds can be issued by governments, corporations, or both from different countries, allowing investors to access a range of international markets and potentially benefit from higher yields. These investments also come with certain risks such as currency fluctuations and political instability, which should be taken into account before investing. When considering investing in foreign bonds, it's important to understand the specific risks associated with each investment. Investors should consider the creditworthiness of the issuer, any restrictions on repatriation of funds, potential tax implications and currency risk. Additionally, understanding how changes in interest rates may affect any returns is important when determining if foreign bonds are right for you. Asset-backed securities. Asset-backed securities, ABS, are a form of debt securities, which are backed by physical assets such as mortgages, auto loans or credit card receivables. These securities have become increasingly popular in the world of finance over the past 2 decades due to their ability to provide investors with high yields and lower risk than traditional bonds. In fact, ABSs can offer higher yields than government and corporate bonds while still providing exposure to diversified asset classes. An ABS is typically structured as a security that is issued by an entity called a Special Purpose Vehicle, SPV. This SPV pools together various types of assets such as mortgage-backed securities or auto loan receivables and issues debt obligations against them. The debt obligations are then sold to investors who receive regular payments from the underlying pool of assets until they reach maturity. In conclusion, bonds are a great investment option for those looking for a reliable, low-risk financial instrument. Bonds offer multiple advantages over more traditional investments such as stocks and mutual funds. With their secure returns, bonds make an excellent choice for retirees or those living on fixed incomes. Furthermore, by diversifying their investment portfolio with a variety of different bonds, investors can reduce overall risk in the event of market downturns. When deciding whether or not to invest in bonds, it's important to look at your individual goals and risk tolerances. Bonds can provide stability and steady income but may not yield significant returns like other investments might. Additionally, bond prices can fluctuate due to changes in interest rates, so investors must be aware of current conditions before investing in them. Don't forget to like, comment, share, and subscribe for future content. Thanks for watching.